as I mentioned, down around 1.5% for the NSE as a whole last week. Flat, slightly to the positive into today's session. Do you think that we could actually see more positivity going forward? It seems the banking sector still seems to be the preferred place to be for a lot of the foreign investors.
Yes, thank you very much. Well, we saw the market hedging up a bit for 0.14% today. And like we experienced on Friday, it's same banking sector stocks that have lifted the market. I mean, the expectation is that there are positive indication that we're going to get some strong report from the banks, which results are supposed to start coming out by the end of the week and next week. So, I mean, it's just like I said, based on the expectation of the investors of some good corporate actions that will start coming in anywhere from now. We can't say exactly that this is going to be the long-term pattern that we're going to see. But, I mean, for this week, we might have more positive than negative, unlike what we have last week when the market closed quite very badly.
When you also look at a lot of the initiatives taken by the SEC and the NSE as well to try and change sentiment towards the market, it seems that it's happening to no avail. Do you think we're going to start seeing a significant change when it comes to the equity markets? A lot of people dumping equities to move into the fixed income space.
Well, yeah, I understand with what people could be saying. I mean, when they see the performance of the equity market, it looks as if the best way to be now is the fixed income market. But like you rightly said, there have been a lot of initiatives by the NSE and the SEC in trying to help the market. But I must say, the economy as a whole, I mean, or let's say the management of it, is quite causing some signals, or let's say development in the economy is sending some signals to investors that the equity market might not just be ready for immediate attraction by so many other people. For example, we have quite good initiative like allowing some other derivative products like the exchange traded fund or to be traded on the market, which you see a lot of foreign investors being very happy about. There are quite a lot of other initiatives like making the market to be quite expanded and to implore quite a number of other bigger companies to list on the market. However, because of quite a lot of things that happen in the economy, like security risk, exchange rate devaluation or depreciation, it actually kind of disincentives to some other international investors from coming to the market.
Femi, also when you look at the unemployment rates, we know that since 2004, we've seen a massive increase in those unemployment numbers, particularly coming through on the youth front. This is obviously quite a growing concern because it's also indicative of the fact that despite the fact that Nigeria is growing at quite a larger pace, and when you see what you see in the developed market, it's still not enough to ensure that enough jobs are being created. How does this also change the sentiment towards the markets as a whole in the country?
I mean, clearly, this is a paradox, I must say, because, I mean, if you like growth in the economy, and then we are having kind of high poverty incidence and unemployment rate, it's quite worrisome, I must say. It beats any rational economics, and that tells us that there are quite some structural issues that the nation needs to sort out. However, in terms of impact, we know clearly that the capital market should be the place to go to after you have sorted out the immediate need of yours. It's for savings and investing for the future. But if the economy cannot even sort out of its current needs, like we have seen with the high incidence of poverty, it has serious effect on what we should expect to see on the capital market. So, and that's where you would see that the capital market is actually reacting to it strongly, because now we have seen that the appetite for domestic investment is actually going down. And again, like I said earlier, the risk, the uncertainty in the market is not really so friendly to even the international market, international investors that we have relied so much on to help us with the market. So this unemployment and incidence of poverty is actually an effect, which we think right now what the economy needs to do is to see how we can connect the growth in output to employment to sorting out poverty.
Femi, let's also just touch on the inflation number that came through, because these are shocking numbers, given the fact that we've actually seen a significant increase from the month of December. Inflation rising to 12.6% in January, from around 10.3% in the month of December. Food inflation being an issue. We know that fuel is going to be an issue going forward, despite the fact that the subsidies have been partially removed. What kind of impact is this going to have on the interest rate environment?
Well, again, it looks very big, I mean, as the jump in the 10.3% to 12.6% in January, but this is expected. Earlier on, we've always been happening on the fact that the deregulation, or let's say the removal of the first subsidy, is going to lead to some attendant high inflation. Yes, the Monetary Authority is quite aware of this, and they've put a kind of containment into it by saying that, you know what, there is a limit at which we can still absorb, you know, based on the kind of growth we want for the economy. So what we have seen is not so very shocking as should be. We expect, to me, I'm still expecting that we could still have a kind of worst case scenario of having up to 13 to 14% before the end of the year.
Fantastic.
However, but what we've seen is actually temporary. I mean, this is just the first month, and the effect was great in January. We might see more moderation along the line as we move towards the center of the year.
Fantastic. Thank you, Femi.
So it's really not big now.
Brilliant. Thank you so much, sir, for joining us.